This is WealthBT, a podcast of BT correspondents.
Ironically, the first thing I did was invest in a hedge fund, which is like really, really crazy. The returns were negative over a long period of time, so it wasn't great.
How successful are you as an investor? Are you able to stay invested and earn compounding returns? Honestly, for myself, I've made some pretty bad mistakes. More than 20 years ago, I invested in a global tech fund, literally at the peak of the tech bubble in early 2000. Just 2 or 3 months later, the fund was in free fall as the bubble burst. I think I lost 80% of the $10,000 I put in. Eventually, that fund was closed. I got back slightly more than my capital, but that's not a good result at all. I think I might have done better in a fixed deposit. Welcome to WealthBT. I'm your host, Genevieve Cua, wealth editor of the Business Times. Every week, my colleagues and I break down a business story that matters. What are some investing mistakes you've made? Do you find yourself making the same mistakes over and over? There are strategies and approaches that can reduce your stress, simplify things, and keep you on track towards your financial goals. Steve Brice is with us today to share some of his experiences and insights. Steve is the Global Chief Investment Officer with Standard Chartered Bank. He's had more than 25 years of financial markets experience. Welcome to WealthBT, Steve.
It's a real pleasure to be here. Thank you so much.
Let's start from the beginning. How did you get started in finance? Was it something that always interested you?
So I was asked to do some work experience when I was at school. My aim then was to be a hotel manager. So I actually worked in a hotel in Stratford-upon-Avon, found out that hotel management was not my thing, and then was looking for something else to do. So when I was applying for university, I chose to do economics and then went down the finance stream and then really just fell in love with it.
So when did you begin investing yourself? And what do you see as your biggest weaknesses and what do you get right?
I was a typical investor, right? So when I started work during the irrational exuberance days of the late 1990s, so when Greenspan was basically telling us that markets were too frothy and they would come down, and I bought into that wholeheartedly, so I delayed investing. So my first investment was basically buying into a story. Ironically, the first thing I did was invest in a hedge fund, which is like really, really crazy. I got my money back, less the sales commission 7 years later, but the returns were negative over a long period of time. So it wasn't great. I grew up reading a lot about Warren Buffett, right? So I was going to be the next Warren Buffett, and I realized I don't have probably the patience or the intellect that he has. I learned the hard way that probably wasn't the best way to do things, and that set me on my journey to start investing properly, sort of around the early 2000s.
So you've done well.
Yeah, could always have done better. I guess hindsight's a great thing. Time is your greatest asset as an investor. So the earlier you get started, the more you learn about yourself. I think that's probably the key thing that people need to focus on, less about what's happening in the market today, but how they're feeling about the market and how they might mitigate some of those biases as they go through the journey.
Steve, what do you see as the biggest mistakes that people make and how can these be overcome?
Yeah, so I guess it comes back to two things, right? So the first thing is they delay. And the second thing they do is they have too narrow investments. So either individual stocks or ETF exposures for specific sectors. People try to think they can predict what's going to happen. And the second thing is they have negativity bias as well. You delay because you think that markets are going to weaken. I think now is a great example of probably people having that fear in their thoughts. Markets have been volatile so far this year. And I think there's a lot of people out there saying markets are probably risky or they're going to weaken. So I'm not going to do anything today. And the second piece is at the other end of the extreme is saying somebody comes to you with a great story. These themes, let's take the aging population at the moment, that is clearly happening. There's no disputing that. So therefore, it makes sense that you should invest in that theme. Well, it depends because obviously valuations matter. So if you are investing at a 50 price earnings ratio, then that might not make sense. If it's an 8 PE ratio, then maybe it does make sense.
That's interesting because I get themes all the time.
Yeah. And it's the pressures from clients, from internal stakeholders is saying themes are very, very powerful. We can get clients more invested the more we talk about themes. But what we've said is actually, no, we want to get people in more diversified exposures so that they can invest for the long run.
Mm-mm.
And used wisely, they can be good. The way we look at it was look at your sort of foundation portfolio. So that's where at least 70% of your money should be invested, a through the cycle diversified allocation. And then you can have opportunistic ideas. That's more your entertainment money, your fun money. Nothing wrong, but that shouldn't be the core of your portfolio. That should be on the side. And ideally, you judge the performance dispassionately between the two. And I'm of a very strong belief that your foundation portfolio will outperform your opportunistic ideas.
So the thematic belongs in the
opportunistic bucket, so the smaller area of the portfolio.
Still to come, markets are roiled by Trump tariffs, the threat of higher inflation, and even deflation. How can you differentiate between noise and a genuine concern?
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to WealthBT, a podcast of BT correspondents.
Welcome back. So I'm going to bring it to today because currently there's this threat of tariffs, higher inflation, and so on. How do you advise investors that they can discern noise from a genuine issue that would impact portfolios in the longer term?
Actually, I'd even step back from that. What I mean by that is, firstly, acknowledging that nobody knows what's going to happen. Okay, I need to take a probabilistic view of what might happen, and I need to factor that into my decision making as an investor. So you might say, okay, I believe that the tariffs are going to push the US economy into recession, but you're acknowledging it's a belief, it's not a fact, and say, okay, then I need to invest saying, okay, maybe I'm right, and also maybe I'm wrong. So maybe I don't need to put all my eggs into one basket. The second thing then, what would it mean if I'm wrong? So let's say you think a recession's coming. I say, okay, I'm going to buy US government bonds and nothing else. What if I'm wrong? What if the recession doesn't happen? Then bond yields would probably go up because markets are discounting a probability of a recession today, and equity markets would probably rally. So then my positioning would not be great. Okay, so we should then say, I should be invested in bonds and equities. Then the question is, okay, what are the percentages on my level of conviction that a recession's coming, or on the impact that would happen if that did come to pass? And I think just having that mental process in your brain makes it more dispassionate. You don't have to dig your heels in. You say, okay, today I think the recession risk is slightly higher than it was yesterday. Then maybe the portfolio tweaking is worthwhile to some degree, but let's not throw the baby out with the bathwater.
In other words, you stick to a foundation portfolio, and then at the margin, depending on your view, is that right? Then you do some tweaks.
Yes, absolutely. So
right.
we have what we call a strategic asset allocation model. So for instance, that could be around a 55% allocation to equities for a balanced investor. Okay, if we're a little bit more optimistic, we might make that 60 to 65% equities. If we're a little bit more cautious, that could be 45 to 50% equities. But you still have exposure. This is the hardest thing for people to get past, is saying, if I'm right, I might lose money. But that's okay. Over the long term, you'll still make money. The key thing is to manage the volatility in a way that you're comfortable so that you stay invested through the economic cycle.
And where does someone's age come in?
So typically, obviously, as you get older, you would then be looking at a lower allocation to equities, a higher allocation to high quality bonds. The only caveat I would have to that is, I think people think my time horizon is my retirement age. I'm coming up 53. So my retirement age, let's say it's 65. So a lot of people would say, okay, Steve, then your retirement time horizon is 12 to 13 years away. Whereas I would respond and say, no, my time horizon is at least 40 years. because although I probably will need some of that money in 12 years, I intend to live a long life. So you should at least plan for that. And actually then you should plan for beyond that. I'm basically planning my financial life as if I'm going to live to 100. I'm less than halfway through my investment journey. I've got 45, 50 years that I'm planning for still. So I would generally have a higher allocation to equities than that would suggest.
How hard is it to get people to wrap themselves around that concept?
Conceptually, they get it. If you were to ask most people, their ideal is they go, if you give me my portfolio and I can lock in 5% yield for the rest of my years, then, okay, the capital stays where it is, but at least I'm being paid. That was the challenge that we saw from bond yields when they were very close to zero, right? People were saying, I can't do that 5% anymore. So they're forced to take additional risk to create income. So getting this concept that selling part of your portfolio to fund your retirement is something that people are not that comfortable with, to be honest. They really see it as like going, I get income from my job today. I want to get income from my portfolio. Whereas I'd say, no, you can be paid out of capital and out of income as well.
If you can distill some key principles or strategies that investors cannot do without, what would these be?
The biggest factor that is underestimated is the power of compound returns. So we all conceptually understand that if I get 5% on a return in 10 years' time, I'll get more than 5% of my initial investment. But our brains are taught to think linearly. That's how we are wired. So we really struggle with this compound interest. And part of that is, to be honest, 5% for the first 10 years, it doesn't make that much difference. Even 10 to 20 years, it doesn't. But once you start hitting 30 years plus, the power of compounding really is an extremely powerful force. That does the heavy lifting for you. So the earlier you can start, the easier your journey is going to be. One thing that we did when our boys turned 18, we gave them a small amount of money and said, this is for you to invest. And they both went very different paths. I know the older one who went all into US equities to start with, didn't blink. He said, US market's going to do well. And he was like, this is from 20 years down the road. I don't need to worry about it. Market's down 3%. He calls me, should I worry? Okay, you've learned something about yourself. So then he's now rotating a little bit into bonds. The younger boy had a much more detailed conversation about like the concentration risks of the S&P 500 and really like went through it and like, okay. And then said, okay, I'm going to invest across different asset classes and I'm going to do 3 tranches because he wants to be excited if markets have come down, but also I want to be participating in case they go up.
So he's not worried.
I don't think he even knows the value of his portfolio, which I think is, some people would say that's a weakness, but I'd say, no. That means you're just letting your investments compound. Great.
Earlier, you talked about people's tendency to think that they can predict markets. In addition to that, what other biases you think, the most common ones?
Probably the most damaging one to investors is negativity bias. We know that you can watch financial TV and we know negative stuff sells on YouTube better or gets more likes on YouTube. If you can just fight that negativity bias and say, look, The Psychology of Money was one of my favorite books. And he said, look, if you were to predict what happened to the German economy after the Second World War, people would have labeled you an absolute crazy guy. The economy's just been totally wiped out. And then you saw Germany go on a huge industrialization spree, stock market doing incredibly well, etc. We have an amazing ability as the human race to progress. Don't underestimate that. Don't underinvest in that. The pace of progress, the path of progress will be uncertain. But as long as you're diversified, time is a great healer of any mistakes you'll make.
Thanks for spending time with us, Steve.
So lovely to speak. Thanks so much.
Investing isn't a lot of rocket science, although we heard from Steve about probabilities. You do need to be diversified and have a strategic asset allocation, which is the overall mix of equities and bonds appropriate for your horizon and objectives. But we ourselves are a challenge. We often become overconfident or too fearful, or we think we can time markets, and that often doesn't work out, even for the pros. I hope this episode helps you to take stock of your own approach and strategy. BT Correspondents will be back next week with a new episode on transport. Do check it out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Genevieve Cua. As always, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.